Have you ever wondered whether it's better to invest for the long term or the short term? Well, you're not alone. This is a question that many budding investors grapple with. That's why we're here today to unravel the mystery surrounding long-term and short-term investing strategies. Understanding these strategies is key to successful investing. It's like choosing the right tool for the job. Sometimes you need a hammer, other times a screwdriver. Similarly, knowing when to use short-term or long-term investment strategies can help you navigate the financial markets more effectively. We'll break down these strategies into simple, easy-to-understand steps. We'll explore what short-term and long-term investing means, how they differ, and most importantly, how to choose the right strategy that aligns with your financial goals and risk tolerance. So, are you ready to take a deep dive into the world of investing? Stick around if you want to learn how to make your money work for you, whether you're in it for the quick gains or the long haul. First off, let's dive into the world of short-term investing. Picture this as a fast-paced, high-energy financial sprint. It's all about making the most out of your money in a relatively short time frame, usually less than a year. The types of investments commonly used in short-term investing are varied. They can range from stocks and options to futures and forex trading. The goal? To capitalize on short-term market fluctuations. Imagine a surfer riding the waves, trying to catch the perfect swell before it crashes. That's short-term investing in a nutshell. Now let's talk about the potential for quick, substantial gains. Short-term investing can be lucrative thanks to the power of compounding. This means that the returns you earn on your investment can, in turn, earn returns, and so on. It's like a snowball rolling down a hill, growing bigger and bigger with each roll. But here's the catch. With greater potential for reward comes a greater level of risk. It's important to remember that just as the market can surge upwards, it can also plummet downwards, and often, these movements are unpredictable. This volatility is a key characteristic of short-term investing and can lead to significant losses. Another risk to consider is the transaction costs. In the fast-paced world of short-term investing, you may find yourself buying and selling frequently, and each of these transactions comes with a cost. Over time, these costs can eat into your returns, diminishing the overall profitability of your short-term investment strategy. It's also worth noting that short-term investing requires a lot of time and attention. It's not a set-it-and-forget-it type of strategy. You need to keep a constant eye on market trends and be ready to act swiftly when opportunities arise. So, short-term investing can be a bit of a roller coaster ride with the potential for high highs and low lows. But what about long-term investing? Now let's take a look at the other side of the coin, long-term investing. Long-term investing, as the name suggests, is all about the long game. It's an approach where you buy and hold on to investments for a significant period of time, typically 5 years or more. The goal here isn't to make a quick buck, but to gradually build wealth over the years, allowing your investments to mature and grow. Think of it as planting a seed, and patiently waiting for it to grow into a sturdy tree. In the realm of long-term investing, the seeds are your investments, and these can come in various forms. Common types include stocks, bonds, mutual funds, and exchange-traded funds. These are often chosen for their potential to provide steady, consistent growth over time. Now you may wonder, what's the advantage of waiting so long? Well, one of the main benefits of long-term investing is the magic of compound interest. This is where you earn interest on the money you've invested, and then earn even more interest on that interest. It's a snowball effect that can lead to substantial growth over time. Another perk of long-term investing is the favorable tax treatment. In many countries, including the United States, long-term capital gains are taxed at a lower rate than short-term gains. This means you get to keep a bigger slice of your investment pie. Long-term investing isn't about timing the market or making knee-jerk reactions to short-term trends. It's about choosing solid investments, holding on to them, and letting time do its work. It's a strategy that requires patience, discipline, and a focus on the bigger picture. But don't be fooled into thinking that long-term investing is a snooze fest. It's not about sitting back and doing nothing. It involves regularly reviewing your portfolio, rebalancing when necessary, and staying informed about your investments and the broader market. Long-term investing may not give you the adrenaline rush of short-term investing, but it's a reliable way to grow your wealth over time. So, if you're looking for a strategy that offers potential for steady growth and the benefit of compound interest, long-term investing could be the way to go. So, we've looked at short-term and long-term investing separately, but how do they stack up against each other? Let's delve into the comparison. Short-term investing, as the name suggests, involves holding on to your investments for a brief period, typically less than a year. The goal here is to capitalize on short-lived market trends. The potential returns can be substantial, but so are the risks. The stock market can be volatile, and short-term investing can feel like riding a roller coaster with highs and lows that can be unpredictable. Moreover, it requires a significant time commitment. You need to be on top of market trends, news, and data to make informed decisions. On the other hand, long-term investing is a marathon, not a sprint. It involves buying and holding on to your investments for several years or even decades. The potential returns may not be as immediately gratifying, but they can accumulate significantly over time thanks to the power of compound interest. The risk is generally lower compared to short-term investing, as the market has historically trended upwards in the long run. However, it requires patience and the willingness to weather market downturns without panic selling. Now, which strategy is better? Well, it's not as simple as choosing one over the other. It's about aligning your investment strategy with your financial goals, risk tolerance, and time commitment. Are you saving for a short-term goal like a vacation or a down payment on a house? Short-term investing might be the way to go, but if you're building a nest egg for retirement, long-term investing might be more suitable. Remember, every investor is unique. Some might thrive on the adrenaline rush of short-term investing, while others might prefer the steadier pace of long-term investing. It's important to understand your own comfort level with risk, and how much time you're willing to dedicate to managing your investments. When it comes to investing, there's no one-size-fits-all approach. It all depends on what you're looking to achieve with your money. So, we've taken a journey through the world of investing, from the fast-paced realm of short-term investments to the steady growth of long-term ones. In the process, we've shed light on two distinct investment strategies, each with its own merits and potential pitfalls. In the realm of short-term investments, we've seen that this strategy can offer quick returns. It's like a sprint, where speed and timing are everything. Short-term investing can be exciting and rewarding. However, it requires constant attention and can carry significant risk. It's not for the faint of heart, but for those with the time, resources, and appetite for risk, it can be a profitable venture. On the other side of the coin, we have long-term investing. This strategy is more like a marathon, where patience and endurance are key. It's about the power of compound interest, the magic of time, and the steady climb of value. Long-term investments typically carry less risk and require less daily management, but they also require patience and a commitment to the future. But let's not forget that investing is not a one-size-fits-all proposition. Every investor is unique, with different financial goals, risk tolerance, and time horizons. When choosing an investment strategy, it's crucial to consider your personal circumstances. Are you saving for retirement, or are you trying to accumulate wealth quickly? Are you willing to take on more risk for potentially higher returns, or do you prefer a more conservative approach? These are all important questions to ask yourself before deciding on an investment strategy. To sum up, short-term investing is about speed and timing, while long-term investing is about patience and growth. Both strategies have their place in the world of investing, and both can help you achieve your financial goals. Whether you're a thrill seeker or a slow and steady investor, understanding these strategies is your first step towards making your money work for you. Remember, the best investment strategy is the one that helps you reach your financial goals.